There is currently a major market crash underway. This specific area of the market is now down more than 40% since December 2021, and you may not even realize it. And I'm not referring to any area of the stock market. I'm talking about bonds, specifically bonds maturing in 20 years or more. What's perhaps most shocking about this is how little attention this massive crash has garnered. This has rivaled some of the worst stock market crashes in history, including the global financial crisis. Traditionally, U.S. government bonds are viewed as a safe haven by investors, a place where they can store money to protect their principal while earning a bit of income. However, as this crash has shown, it is not always as simple as one may think. With a closer look at the performance of the 20-plus year Treasury bond ETF, TLT, we can see that it is down more than 41% over the last 22 months. Again, these are US government bonds, down 41% in less than a 2-year period. This is a stark reminder as to the possibility of volatility in bonds, something too many investors never consider, finding themselves exposed to massive downturns right when they may need the funds the most. The cause behind this crash is not a lack of faith in the US government or a fear that they'll be unable to repay their debt, but something that's more closely related to the length of time until these bonds mature, providing the investors with their original investment back. Essentially, anyone who has invested in these bonds over the last few years likely locked in a rate as low as 1% after the Federal Reserve dropped rates dramatically to help weather the COVID crisis. Once they began to rapidly increase rates instead, there were a large number of investors left holding the 10, 20, and 30-year bonds that were paying next to nothing in interest, when you could now receive a far better interest rate in the current environment, one closer to 5%. This caused the older bonds to drastically plummet in value, leaving investors with a massive loss in the safe portion of their investment portfolio. Fortunately, at Presilium, we have preferred short-term bonds, those bonds that most often mature in 2 years or less. This allows us to limit volatility as rates move up and down, and which in turn gives us the flexibility to purchase additional stock as part of rebalancing when we have the right opportunities. Thank you, and I look forward to talking with you again soon.